And he is at the helm of arguably the most successful boutique investment bank, although he hates that term. A year after the fall of Lehman Brothers and AIG, Evercore Partners is adding staff, beefing up its money management arm, and also hoping to pounce as the M&A market reaches a bottom. And it doesn't hurt, by the way, that its stock recently, or is sitting at a 52-week high. And I'm very pleased to be joined by Evercore's still new CEO, Ralph Schlosstein. And Ralph, thanks so much for being with us.
Thank you very much, Betty.
So you actually took over in May, I believe.
Yes, that's
so
correct.
Then we still consider you new on the job.
I'm still learning my job.
Okay, so a year on out, Evercore has done very well. The bank, the big Wall Street firms, of course, have not, and some are still struggling, and some are coming back, like Goldman Sachs and such. But where do we stand now? Where do you think we stand now in terms of the banking industry, but also your firm in particular?
Well, I think, first of all, there is a comeback in the banking industry. We are past the point where we were staring into the abyss and we were concerned about free fall. And bouncing back from that has been a very rapid process because there was a lot of fear in the market. Now the real question is, where do we go from here? We've now hit a more equilibrium point, and we need real growth in the economy and real confidence to move beyond this point. And I think we'll see the larger banks with their balance sheets start to deploy capital again. We're starting to see that because they rebuilt a lot of capital in the spring and early summer. But we believe over the long run, the firms, the smaller investment banking firms that everyone else calls boutiques,
like yourself, right,
will take market share.
Are you pretty confident where you are right now?
We feel good about our position. It's a highly competitive industry. There are lots of small firms we compete with and lots of large firms that we compete with. But we're doing very well this year.
Okay, I'll talk a little bit about your asset management business because I know that's one that you're trying to build at Evercore. But in the meantime, at a Barclays conference earlier this week, you were talking about the M&A cycle, and you see that we're at the bottom. What are those indications?
Well, I think, first of all, the M&A business is a long-term growth business, but it's cyclical. It's generally characterized by 5 to 7 year up cycles and 2 to 3 year down cycles. We're well into the second year of that down cycle. None of us are smart enough to predict exactly when the bottom will occur, but the things that you need to turn that around are, number one, some visibility about the future of the economy, which we're starting to see. Number two, healthier capital markets, and clearly the recovery in both the stock market and tightening of corporate spreads is starting to produce that. And then finally, CEO confidence. There's no real measure of that out there, but Evercore and other firms talk to lots of CEOs, and I think I can tell you that...
And what are they telling you?
They're telling us that they are no longer concerned about or seeing free-falling profitability. They've cut their costs. They see a stabilization in profits. And if we get some growth now, I think there's a lot of earnings leverage in these companies. And that should stimulate the combination of the markets, the economy, and executive confidence, a pickup in M&A. Whether that starts the second half of this year or the first half of next year, no one's smart enough to know that.
It remains to be seen at this point. Okay.
Although we have seen 8 larger than $1 billion deals announced in September already. So that's an early sign.
And some of the ones we reported on already and that you've advised as well.
That's correct.
Okay, Ralph, just hang on. We're going to be with you. We're going to be back with you after the break to talk more about M&A, but also about Wall Street pay and the Fed regulating that. What's his reaction? Keep it here on Bloomberg News. I am back with Ralph Schlosstein of Evercore Partners. And Ralph, right before the break, we were talking about the M&A cycle. And, of course, we go through this year after year. But every time we come out of an M&A cycle, though, something changes in the landscape. So this time around, what's the big change that you've seen?
Well, the big change, first of all, the cycles are always stimulated by something. So in the late 1990s, it was stimulated by the stock market and the Internet boom. In 2006, 2007, by the very easy availability of credit. Both of those were followed by a crash in M&A activity. And what really turns it around is markets, strength in the economy, and CEO confidence once we've come through that period of bust. Hopefully, the next time we won't have a bust like
But this time around, though, as we emerge out of it, though, M&A is going to be different. How?
I think probably the big stimulus for M&A this time is going to be, number one, increasing consolidation in markets, because if we have a slow-growing economy, the way to get profit growth is going to be consolidation and cost takeouts. And the other big thing, we believe, is going to be cross-border. Mature companies buying positions in the emerging or faster-growing economies, and the high cash flow economies like China, India, Brazil, buying positions in already mature industries in the mature world.
That's interesting. Okay, I want to move on though to the hot topic of the day, which is always actually the hot topic, which is banker pay, and the report out in the Journal about the Fed possibly, or the Fed getting ready to regulate Wall Street pay. Anywhere from CEOs to traders, your view? Well,
I think we clearly have had some practices in the past that were bad for shareholders and ultimately bad for the government. They paid on the basis of short-term performance when significant long-term risks were being taken. That's a bad plan. The way
and that should be eradicated.
And that should be eradicated. I would hope that boards, compensation committees would be doing that without the urging of the Fed. But if we need the Fed to accelerate that process, no harm in that. I think the key thing is not to get into individual people's pay, and quite honestly, not to get shocked if someone who's an outstanding producer makes outstanding compensation.
But what about somebody like Andrew Hall at Fibro?
Yeah, I think what the Fed is going to focus on, which is appropriate, is to make sure that the plans themselves do not encourage risk, and that there's not pay for risk as opposed to pay for real value created for shareholders.
Okay.
My understanding of the Fibro business is that it uses relatively little balance sheet, it takes relatively little risk, and he's making money based on his intellect and his relationships. We should be willing to pay for that. How much? That's Vikram Pandit's decision.
Right, and it looks as if he's given his decision, but there's still more to come, I'm sure, on this. Okay, Ralph, thank you very much. We've run out of time. Love to have you back on to talk more about the asset management side of your business. That is Ralph Schlosstein of Evercore.